Thank you for joining us for Bankrolling Your Business, Positioning Your Company for Bank Financing. Cashflow Engineering offers free resources, tools, online courses, and training, as well as personal assistance through a network of faculty and cash flow engineers to help you better manage your business and cash flow. The ultimate goal is to save you time, energy, and money. And if you go to our website, cashflowengineering.com, and click on one of our business area icons, you will see a screen like this, which gives you access to our tools and resources. At this point, I'd like to introduce Phil Randell. He has 38 years of experience lending to companies and real estate projects. His lending experience includes commercial loans for working capital, equipment, real estate, as well as construction loans for new project builds. He's been employed by both large super regional banks like U.S. Bank and Wells Fargo and community banks, and that's where I met Phil many years ago. He served in various leadership positions in banks, directing and managing high-performance lending teams. He's been elected to the board of directors of Solera National Bank, which is a community bank here in Denver, Colorado. Phil is a personal friend of mine, and we've done a lot of work together. So without much ado, I'm going to introduce you to Phil Randell.
Thanks, Jeff. I am pleased to be a part of Cashflow Engineering, and I look forward to sharing my thoughts on companies obtaining bank financing in this presentation. As you can see, we're going to cover three areas here. Determining how much money you need and how to structure a loan deal, understanding how a banker sees you, what the bank considers when granting a loan request. How much money do you need? Well, if you're going to finance equipment or real estate, that's rather easy. You just look at the invoice amount on the equipment invoice or the amount in the purchase contract for real estate. But if you need money for working capital, you're going to have to spend a little bit more time figuring that out. You'll see a slide here for financial forecasting in Microsoft Excel. This is a book that was written by my colleague Jeffrey Prager on how to do financial forecasting. It's a good bet that if you seek term financing from your bank, they're going to ask you for some financial modeling. This book is an excellent tool for you to use in that regard. And as Jeff alluded to earlier, you can go to the website and actually order this particular book. Okay, once we know what the loan purpose is for and figuring out if there's any kind of a cash gap and know when we're going to obtain the cash flows that will be used to pay the loan back, we can begin to structure a loan deal and what we can offer to the bank. This slide is meant to cover what's known in finance as the cash gap. What I'd like to have you think about is purchasing inventory on day one, and as you can see, we're not going to sell that inventory until 60 days. And then when we sell that, we're going to sell that on credit and have accounts receivable that we will collect in another 60 days. So we've got a total of 120 days right there. Now, the supplier of inventory is probably going to give us some terms, most likely net 30. And that's where we're going to have to pay the supplier for the inventory. So there is 90 days remaining where we're receiving no cash, yet we had to extend some cash. And that 90 days is what is known as the cash gap. That is what is commonly shown as working capital financing. So now that we know what the loan purpose is and we know when we're going to use the funds and when revenues will be collected, we now can begin to structure and offer something to the bank that's of consequence. So how much of the total cost can you provide? If it's real estate or equipment, it's a good bet that you're probably going to have to supply about 25% of equity, or as it's also known as skin in the game. Remember, a bank most likely will not finance 100% of any transaction. Structuring a deal is as much a science as an art, but before you consider how to do it, you must know the economics of your project, and you must know the capital structure. How much equity do you provide, and how much is the lender going to provide? Keep in mind, bank financing is generally the cheapest source of financing in the marketplace. However, since the returns to the bank are not huge, the transaction must not present excessive risk to the bank. Keep in mind, longer term loans will finance long-term assets such as equipment, real estate, and other fixed assets. Shorter term credit facilities will typically finance working capital needs. These short-term lines of credit may be 1 or 2 years in duration, and they'll be used for inventory purchases, salaries, and operating expenses associated with the sale of the project, which results in the creation of accounts receivable. Okay, moving on. How does the banker see you and your company? The banker sees the company different than you do. Keep in mind, bankers are looking at a myriad of loan deals on a daily basis. They may be in the same industry as your company, or they could be in different industries. So the banks are going to focus on the financial records, reputation of your company, fixed assets, current financial strength, work in progress, management ability, future plans, and profitability. Now, this is some basic facts and a brief income statement of a fictorial company. This is a fact sheet of an income statement for a company that has net profit after tax in 13 of 405, in 14 252, and in 15 624. This begins to show the bank what kind of cash flow is available to service debt. As you can see, this is commonly referred to as EBITDA, and that's an acronym for earnings before interest, taxes, depreciation, and amortization. So as you can see from this slide, the EBITDA is noted there below. The next slide is EBITDA to debt service. All this is EBITDA divided by the debt service that the company has. The numerator is, again, the EBITDA from the previous slide. The debt service is really the interest. In this particular company, you will see that the only debt it has is a revolving line of credit. Therefore, the only debt service it has to service is the interest only on that revolving line of credit. So the resulting debt service ratio is 80 to 1. The next year it's 100 to 1, and the next year 750 times 1. These are extremely strong debt service coverage ratio. This company would have the ability to take on quite a bit more debt if it so chose. The next slide is the current ratio. The current ratio is defined as current assets divided by current liabilities. Current assets will consist of cash, inventory, and accounts receivable, and current liabilities will consist of short-term payables, interest owed on a revolving line of credit, and any current maturities of long-term debt due within the next 12 months. As you can see, the ratio is over 2, and this is pretty representative of a fairly strong company. At least you want this ratio to be 1 to 1. If it's less than 1 to 1, banks will begin to question, can you meet the upcoming liabilities due within the next 12 months? Now, in our workbook, which you will be shown how to obtain at the end of this presentation, you will be shown how to calculate all of these ratios that we've just gone through. Okay, the next slide is the 5 C's of credit. They are number 1, character. What does that mean? Well, that's the owner's commitment to the business, management experience, and integrity. Capacity is number 2. What is the amount of cash flow that can service not only existing debt, but the new projected debt? Number 3 is capital, also known as net worth. As you know, total assets are financed by both creditors and owners' capital. So this will measure how much the creditors are financing of total assets versus the owner. Number 4 is collateral. These are the assets that are going to secure the loan. Number 5, conditions. And these are conditions that exist in both the economic and political environment that exists today and that is projected in the future. Now, what does the banker do when it actually considers the loan request and it's working on the credit request in the bank? It may have some credit analysts spreading financial statements, et cetera, et cetera, et cetera. So let's get involved in this. What banks want to see are the highest quality of financial statements that can be obtained. And the kinds of financial statements that the bank will require is largely dependent upon the amount you're asking to borrow from the bank. In my career, I've made loans of $50,000 and loans of $25 million. And when you get to borrow from a bank in the range of $5 to $10 million, I can bet you're probably going to be asked to supply CPA-prepared audited financial statements. If you're borrowing $50,000 or $100,000, chances are company-prepared financial statements might do the trick. Now, if they are company-prepared balance sheets and income statements, hopefully the balance sheet balances. I can tell you many times in my career I have seen this not to be the case. And you want to go to the bank with your best foot forward. So please make sure that your financial statements balance. The banks also want to see profits and cash flows in the company that are sufficient to, again, pay all of the existing debt plus any new debt that's requested. They want the financial ratios of the company to compare favorably to industry norms, and they want to see evidence of strong management in the company. The next slide is the best measure of cash flow for the banks is EBITDA. And again, earnings before interest, taxes, depreciation, and amortization. To ensure cash flow is sufficient to service the debt, banks seek a minimum EBITDA to annual principal and interest payments of 1.25 times to 1. This cash flow needs to be consistent, predictable, and sustainable. Sound familiar? It should. That is cash flow engineering's purpose. Lastly, will cash flow be reserved for the loans, or will the executives of the company use it for some other purpose? Banks are going to want to also probably take a look at other ratios, the quick and current ratios, and debt to tangible net worth ratios. These ratios should be generally in line with industry standards. If they are outside of industry guidelines, then there may be more risk to the bank, which may need further mitigation. Banks may want to set loan covenants using some of these ratios. When I think back of all the lending done in my career, most of the times we had a debt service coverage ratio, and many times would also use the debt to tangible net worth and sometimes the current ratio. You can get industry standard ratios from industry trade associations, CPAs, your bank, or the Risk Management Association publications at the library. The primary source of repayment for bank loans is cash flow. and that is noted as EBITDA. The secondary source of repayment is generally going to be the collateral and personal guarantees that are offered up by the owners. The bank will analyze your industry. The competitive environment weighs in on a bank's decision-making process. What is the current industry the company is in today? Are there inherent weaknesses or strengths? Who is your competition? Where is the industry headed? What is causing the direction? How are you positioned for this future? What is the company's strengths and weaknesses within its industry? What sets it apart from the competition? What is your company's value proposition in the industry? In other words, why are customers going to buy from your company? How is the company affected by the economic and business cycle? And then you'll want to present multiple scenarios to benchmark against. The bank will also analyze the company's management. Good financials, strong cash flow, and a good competitive position, none of it matters if there's bad management. Good managers and leaders follow their numbers and understand their importance, and they understand the impact of the actions on their company's overall financials. Good managers and leaders understand risks that they face and sufficiently mitigate those risks. They generally don't bet the farm. Good managers and leaders plan. However, they also understand that things do not ever work out as entirely planned. That's exactly why they plan for all eventualities, including unforeseen ones. Character of the management team. If you were lending the money, surely you'd want to know as much as you could about the person to whom you are lending. Would you lend money to your company? So, what is it that bankers want to see when it comes to character? Well, what I can tell you are two main things, and this was used successfully in my career. First of all, high integrity in the management team. We need to be sure we have this. Be honest with you, sometimes loans don't work out the way they're planned, and you want your management team to be communicating with you as crisply as possible. Secondly, you want management experience in the industry or at least a related industry. And then thirdly, you probably want the willingness of managers and owners who own at least 20% equity in the business to probably personally guarantee the credit facilities. Next is collateral. Collateral proves to the bank or the lender that their money is safe. Collateral is viewed by the lenders as a secondary source of repayment, what it may need to rely on if the primary source of repayment, like cash flow, falls through. What are the risk factors, such as obsolescence in the assets, cost of maintenance of assets, and do you need a third party to assist you in selling the collateral if it ever comes to that? These are all the risk factors that the bank considers. So how will you mitigate the risk? Well, you're probably going to be asked to provide insurance, naming the bank as loss payee on those assets serving as collateral. And if it's a fleet of vehicles, they may ask for your maintenance records to ensure that those are in tip-top shape. They may ask for additional collateral. There are many times where when we analyze the business assets of a company that we were going to lend money to, it just was on the line. And we thought maybe we needed a little bit of additional collateral. And so we might have asked for a piece of commercial real estate or the residence of the business owner as additional collateral. Now, you're going to ask, what do we mean by this umbrella? And I'm going to ask Jeff to provide a comment here.
We had an old saying when we dealt with bankers. Bankers are the type of people who will lend you an umbrella but want it back as soon as it starts to rain. So with that in mind, make sure that you are borrowing or positioning your company to borrow long before you need the money.
Well spoken, Jeff. I guess we bankers do deserve that comment from time to time. Okay, now we want to determine the right source of credit for your company. What I would tell any company, try to borrow from the bank. However, since banks are in a regulated environment, the credit really needs to be pretty pristine. So, factors for you to consider when you're considering who to borrow money from: how long have you been in business? How much money do you need? When will you need it? How will you pay it back? And what are the risks associated with the loan? If those risks are fairly great, you may not be able to obtain bank financing. This next slide is a slide that my colleague Jeff Prager has put together, and it outlines financing sources outside of banks for various kinds of assets. And I'm going to ask Jeff just to make a few comments here about this particular slide.
Thanks, Phil. On this slide, what we're looking at is other ways to finance or use alternative funding to finance your company. And as a preface, let me tell you this. Over the course of my career, I've helped companies position themselves to raise over $1 billion. And quite frankly, 200 million of that went to my own companies. The bank is the cheapest form of financing, but you're not always bank financeable. So if you look through the various assets like working capital, receivables, equipment, leases, real estate, there are different sources that you might try to approach about getting money. And in the third column, when I wrote this schedule, this is about what you could borrow on those assets. But again, not always are the banks your only source of financing. But you really need to look at what you need, when you need it, how you're going to pay it back, and what's the risk associated with the asset, and then determine who your best lender might possibly be. We cover everything that Phil's talking about and that I'm talking about in our Bankroll Your Business book, and we'll tell you more about how to get that in a few minutes.
Thank you, Jeff. I would just add that over my career, I have struck up relationships with other non-bank lenders and directed clients to those non-bank lenders, such as an asset-based lender. The bank was probably not in position to make the loan because of various considerations. However, we'd make the referral to an asset-based lender, and the asset-based lender would provide financing to that company for 2 or 3 years, and then the company got profitable, retained some of that profitability, and all of a sudden at the end of a couple or 3 years, it was bankable. So that's what we tried to do with our particular clients so that we could be a value add for them. So we get to the conclusion here. If you meet the following criteria, there is a strong chance your company will be the recipient of bank financing, some of the best financing available because it bears the lowest interest rates. Those criteria are your cash flow coverage of 1.25 times or greater, calculated as EBITDA divided by debt service, your current debt to tangible net worth and any other financial ratios are in line with industry standards, you meet the 5 C's of credit, and you and your company exhibit solid management or leadership skills. Lastly, you need to give the banks or the lenders the information they need to make a decision. Give them answers before they ask the questions. Show that you are responsible, professional, and organized. And if you follow our advice, maybe you'll hear the following words. Here is the check. And that's what we do want you to hear. So with that, I sincerely thank you for your time today, and hope what we presented was meaningful and helpful. Now I will turn the microphone back over to my colleague, Jeff Prager.
So our goal at Cash Flow Engineering is to give you free tools and other tools to help you create a successful business. With this program, we're offering a workbook for creating a bankable loan. And in this workbook, we're going to cover everything we covered throughout this presentation in a whole lot more detail, including cash flow ratios, and we're going to even give you a worksheet so that you could calculate your own. We're going to give you the 5 C's of credit, and we're going to talk about management and leadership of your company. Normally, we provide this at a greater cost than what we're offering right now. The workbook will be $25. And we'll show you how to get it in a second. As you know, some of our goals are to give you the help you need at a very, very reasonable price. And we've asked Phil if he'd help you. So not only are we going to give you the workbook for $25, but if you'd like a half hour of Phil's time, we're going to offer it with the workbook for $165. That's well below his hourly rate. Now, if you don't feel a half hour is enough time, Phil's been generous enough in offering us a full hour of consulting plus the workbook for a total price of $245. So how do you get your copy of the workbook, the spreadsheet, and everything else we've talked about? You go to www.cashflowengineering.com, that's cashflowengineering.com/bankable, and you'll find an order form so that you could receive your materials and set up your time with Phil right there on the internet. At this point, we'd like to thank you, and we hope that you've enjoyed this program, and hopefully we'll see you at many, many more to come. Thank you very much.